Welcome to Business Education and Research channel. In today's video, we will present the essential strategies for growth and long-term investing in the stock market. These strategies are aimed at identifying companies with significant growth potentials and holding on to them over the years to maximize your returns. Whether you are just starting out or looking into enhance your investment approach, this video will equip you with the knowledge and tools needed to build wealth over time. Let us begin your journey towards successful long-term investing. Understanding growth investing. Growth investing is a strategy focused on investing in companies that are expected to grow at an above average rate compared to other companies. This growth can come from expanding market share, innovating products, or entering new markets. The core principle. Growth investors look for companies that reinvest their earnings to drive further expansions rather than paying out dividends. The idea is to capitalize on the company's future potential for earnings growth, which will eventually be reflected in a higher stock price. For example, Amazon is a prime example of growth stock. Since its inception, Amazon has focused on expanding its market reach and investing in new technologies and services, which has led to substantial growth in its stock price over time. Identifying high growth companies. Key indicators. To identify high growth companies, investors should look for strong revenue growth, expanding profit margins, and a growing market share. These companies often operate in industries that are in the growth phase, such as technology or healthcare. Growth drivers. Companies with a strong focus on innovation, scalability, and market leadership are typically positioned for substantial growth. It is also important to assess the company's ability to capitalize on emerging trends or disrupt traditional markets. For example, Tesla is a well-known high-growth company. It has consistently shown strong revenue growth, driven by its leadership in electric vehicles and clean energy solutions. Tesla's ability to scale productions and innovative in fast-growing industry has made it a favorable company among its investors. The power of compounding concept. Compounding is a process where the earnings on an investment generate their own earnings. Over time, this effect can lead to exponential growth in the value of an investment as returns begin to generate further returns. Long-term impact. The longer you allow your investment to compound, the more significant the growth. This is why starting early and maintaining a long-term perspective is crucial for maximizing the benefits of compounding. For example, consider an investor who placed 1 lakhs investments in HDFC Bank stock in 1995. Due to the power of compounding and bank's consistent growth, that initial investment could have grown to several crores today, demonstrating the massive impact of compounding over the long term. Diversification in growth investing. Strategy. Diversification is the practice of spreading your investments across a variety of sectors and companies to reduce risk. In growing investing, this is particularly important because high growth stocks can be more volatile. Benefit. A diversified portfolio ensures that if one stock or sector underperforms, it doesn't have a devastating impact on your portfolio. This approach balances the high risk of growth stocks with the potential for substantial returns. For example, an investor might diversify their portfolio by holding growth stocks in technology like Apple, healthcare like Dr. Reddy's, and renewable energy like Adani Green, ensuring that they are not overly exposed to a downturn in any single sector. Long-term investment horizon approach. Long-term investing involves buying and holding stocks for several years or even decades. This allows time for companies to fully realize their growth potential and for market conditions to normalize, benefiting from the general uptrend of the stock market. Benefit. By focusing on the long term, investors can ride out short-term market volatility, which often scares away less potential investors. This strategy also allows the effect of compounding to take full effect, significantly increasing the value of the investment over time. For example, an investor who purchased Infosys shares in the late 1990s and held them through market ups and downs would have seen substantial returns as the company grew to become a global IT leader, highlighting the benefits of long-term perspective. Evaluation of growth stocks. criteria. When evaluating growth stocks, it is important to look at financial metrics such as earning per share growth, revenue growth rates, and return on equity. These metrics help assess whether a company is on solid growth track. Financial health. It is also crucial to consider the company's balance sheet. A company with manageable debt and strong cash flow is better positioned to fund its growth and weather economic downturns, making it safer investment. For example, Apple has consistently delivered a strong EPS growth and maintains a robust balance sheet with substantial cash reserve. This financial health has supported its ability to innovate and expand, making it a top growth stock. Risk management in growth investing. Awareness. Growth stocks, while offering high potential returns, are also more volatile and can experience significant price swings. Investors must be aware of these risks and prepared for potential short-term losses. Strategy. To manage risk, focus on investing in well-established growth companies with proven track records and ensure your portfolio is diversified across various growth stocks. This reduces the impact of any one stock's poor performance on your portfolio. For example, startups like Paytm offer high growth potential but come with significant risk due to their unproven business models. In contrast, investing in more established companies like Microsoft, which also offer growth potential, provides a more balanced risk return profile. The role of dividend in long term investing. Income stream. Some growth stocks also pay dividends, providing an additional income streams to investors. These dividends can be reinvested to purchase more shares, further enhancing the growth potential of the investment. Compounding effect. Reinvesting dividends allows investors to benefit from the compounding effect, where the reinvested dividends generate additional returns, significantly boosting the overall value of the investments over time. For example, ITC, despite being a stable growth stocks, also offer attractive dividends. Investors who choose to reinvest these dividends rather than take them as income can accumulate more shares over time, increasing their stakes in the company and benefiting from both capital appreciation and dividend growth. Monitoring and adjusting your portfolio. Regular review. Long-term investors should regularly review their portfolio to ensure that their investment continue to align with their growth objectives. This includes assessing the performance of dividend stocks and making adjustments as necessary. Adjustments. Portfolio rebalancing may involve selling underperforming stocks, increasing investment in successful ones, or diversifying into new sectors. This helps to manage risk and ensure the portfolio remains well positioned for growth. For example, an investor might decide to sell Nokia shares, which were once growth leader but failed to innovate and lost market share. These proceeds could be reinvested in more promising company like Alphabet, that is Google, which continues to show strong growth potential. Patience and discipline in long-term investments. Virtue. Long-term investing demands patience as significant returns often take years to materialize. It also requires discipline to stick with your strategy even during periods of market downturns or economic uncertainty. Focus. Investors should focus on their long-term goals and resist the temptation to react to short-term market movements. By maintaining a steady course and trusting in their investment strategy, investors are more likely to achieve their financial objectives. For example, during the 2008 financial crisis, many investors panicked and sold their holdings at loss. However, those who remained patient and held on to their shares through the crisis eventually saw their portfolios recover grow as the market rebounded. Thank you for joining us in exploring growth and long-term stock market investment strategies. By focusing on identifying high-growth companies, leveraging the power of compounding, and maintaining a disciplined long-term approach, you can significantly increase your chance of building wealth over time. Remember, successful investing requires patience, regular portfolio review, and a commitment to your strategy. We hope this video has provided you with valuable insights to help on your investment journey. Don't forget to like, share, and subscribe to our channel for more expert tips and strategies.